Foreign currency markets. Are they the pin for this bubble? Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Alex, who's actually, we were just discussing, just as we were recording, the interest rate decision came out from the RBA, who kept rates on hold. So we've been keeping our eye on that, plus looking at what's going on in the news today. How are you going, Alex?
I'm going really well. Thank you, Chris. How about you?
Yeah, good. Was that what you expected with the rate
Well,
decision?
it was what I was expected, and I'm still disappointed. It's
Well,
what I want.
I know what you want. For anyone who hasn't been following along, what Alex really wants is the RBA just to make that little nudge in rates, just to get it to a nice round number, not where it is
Down
currently.
or up now, I
Down or up,
don't
she doesn't
mind.
mind. Just wants the round number, and they're not giving it to her, so she's disappointed yet again. Anyway, turning to the news today, you took it down an interesting path today, and one that I don't think we've really talked about before. So it'll be a good one to dig into. You specifically were talking to start off the article about the GFC. And what I really liked about it was you were talking about how there was sort of this instinct at the time that we knew something was wrong, but we couldn't quite put our finger on what it was until it was too late. And obviously, once it had unfolded, we could all see it was really crystal clear. It was to do with mortgages and what was going on there. But can you maybe start us off by exploring this idea of wisdom of the crowds, and how that was relevant then, and probably following that up with where we are today, because I feel like probably today we all have that feeling that something isn't quite right as well.
Yeah, so back in GFC, I guess I was working in finance at the time, and everybody had started talking about mortgage-backed securities and the property bubble in the US, but it couldn't possibly be anything because all the collateralized debt that they had turned the mortgage-backed securities into had AAA ratings. And I
Yep.
mean, they were vetted. Everyone knew that they were okay, but everyone knew, firstly, there was a bubble, and secondly, there was something wrong. And probably from about 2007, you just heard murmurs, and then they go away, and then people will be talking about mortgage-backed securities, and they'll start talking about the CDOs, and eventually it all blew up. But the interesting thing I take from that crisis was just the crowd knew.
Mm.
Everybody knew, and if you probably put together some sort of consensus, the crowd always reverted back to properties, and they always reverted back to bubbles. And so there's a thing, I think it was Aristotle that started the wisdom of the crowd. That was that basically, if you took everyone's comments from a crowd and everyone's ideas, the average of all of those ideas is generally superior.
Yep.
But sometimes when something is so convoluted and so difficult to understand, it just never really gets there. And my comparison and what I was trying to say is, I feel like at the moment there's a lot of chatter and a lot of talk about FX markets. Amex recently pulled out of in fact, yesterday, completely pulled out of the FOREX market in the world, which they were quite strong in.
Yeah.
So you've got them doing that, and you've just got you've got the BRICS talking about gold-backed currencies. You've got everyone worried about FX and inflation differentials and interest rate differentials. And to me, it feels a little bit like what happened in 2008. The crowd knows something's not right.
Yep. So you've given a couple of examples there and I know we've talked about that, and we're keeping an eye on it this month, actually, this idea of the BRICS with the gold-backed currency being potentially something that really shakes things up. And I think that's really what you're saying, that we've got that feeling. We know there's stuff going on in the world that seems to be related with differences between what's happening in, whether it's rates or whether it's fundamental, whatever it is, there's differences going on in foreign exchange markets around the place that are causing everyone this level of uncertainty. But you specifically gave the example of the yen, and this idea of the carry trade. So is that one that sort of really sticks out to you as probably bigger than a lot of these other murmurs, or something that we should be talking about? Because although my attention has been on something like the BRICS example, I haven't really heard much about the carry trade recently. It seems to be something that you talked about in the past, but not really a recent thing that was front and center in people's minds.
Yeah, so the yen carry trade probably has come to forefront again because of Friday and Monday's Bank of Japan reaction. So on Friday, Bank of Japan said, we're going to, tighten our monetary policy again. And then on Monday, they said, oh, no, just yield control curve. So what you saw is a massive drop in the S&P and then a reaction that was opposite and higher earlier. So people, and I found a Reuters article from September 2022. So this is when the US had just gotten to 3% interest rates. And this is when people started identifying the carry trade was going to be the trade for 2023, basically. Yeah. And it really has shown to be quite a good trade for all the Mrs. Now I'm going to say it wrong, but the Wantabi, Mrs. Yep. Wantabis.
The stereotypical Japanese trader, yes, yeah.
The Japanese trader sitting at home and their bank's giving them 0%. But hang on, if I invested over in the US in Apple shares or the Mexican peso, I can get 25% on the Mexican peso. And I mean, Apple's been, 50% this year. So yep. They've been hunting around for better returns. And when you're getting 0%.
And that's, just to clarify that's really what you mean by, so when you say carry trade, you're just saying borrow cheap, put the money somewhere else to make carry, which is just a higher yield than you would have got keeping it at home. That's all that trade means, isn't it?
That's all it is. But obviously then you're just subject to the FX risk.
Yes.
And the asset bubble risk, right? So they're the two things. And what has happened in the past, so when Japan's property bubble burst in 1990 and they've had deflation ever since, they have always kept their rates around 0%. Yep. So going back to 1998, rates picked up, carry trade. Going back to 2005 to 2007, back on the carry trade. It was a little bit, I think, around 2015, 17, but more so it's, these differentials now hit, 5-6%. It's these, the differentials for the Japanese are huge. So they're looking for it. And they have so much in savings. So, yes. The movement of their liquidity into certain markets, and if it's leveraged, is driving things. But the problem is for Japan is they've just hit inflation, I think, of 3.3%. They've been deflationary or low inflation for so long. This has been their goal. But if they keep depreciating the yen, which I think is down like 21% this year, their inflation is going to get too big. So they're going to have to pull this back in, maybe not stop the carry trade, but they're going to have to moderate these carry trades. And if they take a step wrong, there are going to be dramatic swings. So this is where, what I'm trying to show is that these imbalances in interest rates and FX markets in the world right now, and the leverage and risk, just like what happened with the CDOs.
Yep.
It's just been reducing over time. So I was saying to you earlier, I remember working where I was in 2007, and just the desperation to buy debt. And you could just see it, just the margins got so crazy small and the risk just was amplified. You could see it didn't make sense. And the same thing is happening now. And if there is a big movement, or if Bank of Japan goes enough and pulls its head in, these swings can be very dramatic because the risk has not been priced in properly.
I really like the ability to sort of pull that back to what happened in the GFC, because you're right, we do know these things in hindsight as really obvious. And what you've just said on the yen could be one of those that we look back in hindsight and was really obvious. I know at the time it was the ninja loans, no income, no job, and they were lending people money to buy houses. And in hindsight, or even at the time, you should have looked at that and went, this is ridiculous. It doesn't make any sense. Obviously, you have to have a job or some income to be able to borrow to buy a home. You can't just expect the values to go up and just be able to keep trading that way. So if we pull this all together, does this mean, is really what you've been saying today throughout all of this, that foreign exchange markets and currencies are the catalysts that are likely to lead us into this next crisis that we can all feel is coming? We don't, like, it's that wisdom of crowds idea. We all know something's there. Is that, from your perspective, what's coming? And also, what do you think, if that's right, what are the implications for us here in Australia, do you think?
Well, look, I like looking at currencies, I do. So, I probably get more noise around it than most people, but I don't feel like I get the same. People are saying stock markets are overvalued, but people are also saying they can still go up. So I just don't feel like there's that same fear around what could go wrong with it that I remember from previously. So I'm going off what I feel and what, I've spoken to people about, which is, the FX and interest rate markets are what are going to break all of this. I mean, you look at the US debt ceiling, 1.3 trillion in 8 weeks. It is unsustainable. It is out of control, and something has to break. And it seems to be that this could be something that breaks it. Now, just like the GFC back in 2008, 2009, the Australia was not the catalyst. We got punished like the rest of the world, so we're in for the ride. But what happens is commodities generally bounce from these sorts of things, and it pulls the Aussie up. So, we're not going to be the cause, we're not going to be the collapse, but hopefully we get a good ride, and so should gold at the end of it as well.
Yeah, and that aligns with my feelings. It's not just being patriotic. I actually think we're quite well positioned in Australia across a lot of these areas to weather, like we did in the GFC. It's not saying we don't cop it. We do cop it when it happens, but because of our commodity basis and because of the fact that the rest of the world really needs those things that we produce, we do okay. That's probably the best.
We've missed out pretty broadly on the ride up at the moment as a country.
True. But that next phase is where we really stand to benefit.
Yeah, the ride down is where Australia does better, because we don't fall quite as far generally as everyone else.
Yeah. Well, we dig into the tough issues here. So thank you again for that today, Alex. I'm taking the sort of summary of this as the spidey senses are telling us something's not quite right. So we need to rely on that a little bit. But maybe you've given us some specific areas to look at for what this catalyst might be.
When this breaks, everyone's going to look back and go, that was so obvious.
It's always the way. It was so obvious. What were we thinking at the time? Why were you not highlighting it really clearly? Well, hopefully we did. Hopefully you did today. Thanks, Alex.
Yeah, just shoot fish in a barrel with this sort of stuff.
Thanks everyone for watching. Remember, reach out with any questions or comments on the social platforms. That's us for this. That's us for today. We'll be back again on Thursday with Sam to discuss all things markets and metals. Until then, have a great rest of the week, everyone.